The hot hand fallacy, similarly to the gambler's fallacy, is when a person feels that she has a greater probability of future success based on the present success of a random action. For example, if a trader is randomly buying and selling in the market, and out of sheer luck, he produces a winning streak, this trader has the tendency to be subjected to the hot hand fallacy. In other words, he will have the feeling that his future actions will be as easy as the present outcomes. Notice that people who tend to fall in this psychological trap are completely ignoring the role of luck in decision-making. It is imperative to point out that luck always has some degree of influence in our decisions. It's cliché to say that good luck happens when preparation meets opportunity, but that's not completely true in my view. Good luck is simply good luck. The intersection between preparation and opportunity is consistency. Good or bad luck are only inevitable variables that we cannot control, so it's not wise to count on them. The bandwagon effect is when beliefs are amplified because they are already held by a group of people. You might have already noticed that people behave differently when they are in groups. It's not difficult to extrapolate this paradigm back thousands of years ago when this sort of bias was much more useful for our ancestors' survival ability. They probably had to develop some sort of bandwagon effect to fight against dangerous animals, other tribes, and things like that. Let's not be so extreme and say that the bandwagon effect is useless in modern society, but today it has a few diminishing returns. The main problem with this bias is that it tends to make people behave in a more primitive way where the main goal is not rational thinking. It's mainly the integrity of the group itself. It's weird to observe that, in any given group, individuals who increase introspection or try to question in-group members about the group's rules, tend to be ignored or left behind. This is not a bad place to be in, sometimes depending on where the group is headed. This sort of phenomenon can happen in many ways in the market. The most extreme example is when a trader sees price action get unusually agitated and then, out of mere impulse, he jumps on whatever bandwagon he can see, metaphorically speaking. The group he will subscribe to depends on what he knows already, of course, so if this trader likes to trade based on a raw intuition of what the market is doing tick by tick, for example, that's where his impulse will come from. Believe it or not, many people trade like that in the market, which is a gamble, and needless to say at this point, completely mistaken. The moment-to-moment intuition of what the market is doing derived from the most current tick pulses is a dangerous starting point for your actions as a trader. To illustrate with a less extreme example, let's observe the trader who likes to trade based on simple notions of support and resistance. This trader will observe the obvious levels of support and resistance on the chart, and he will prepare himself to act when price gets to those points. If he has no plan of what to do when price does reach these levels, he can simply jump on the bandwagon of the first primal intuition of what the market will do next, which is the same as trading by impulse. All these examples have one thing in common. When traders feel they are missing the bus in the market, they will tend to make any effort, no matter how unrealistically deceptive they might be, just to get in a trade to see what happens. At this point in the course, you can probably imagine how much the market makers love biases like the bandwagon effect. These large traders expect that the vast majority of traders will act by impulse, and that is one of the ways in which the market makers capitalize on retail traders. The zero-sum bias is the tendency to think that when someone wins, another person has to lose in any given system. That is true if you look at the market in the objective light only. However, if we look in the light of the overall value of money contained in a market, the zero-sum classification is wrong. The objective transactions between traders in the market is indeed a zero-sum game if you look at money in the nominal way, meaning if you look at money in objective terms. When you consider all the variables contained in a market, which includes people's subjective interpretation of price, which is called sentiment, you cannot classify the market as a zero-sum game. In reality, the market has the objective layer, and the subjective layer. This second layer makes it impossible to classify the market as a zero-sum game. That happens because the relationship between nominal value and market sentiment varies. In other words, the perceived value of nominal price fluctuates, so we cannot classify the market as a zero-sum game. Oddly enough, our first intuition about the financial market seems to tell us that the market is a zero-sum game, which is just another example of how we can be confused about our surrounding reality. The hindsight bias is the tendency we have to see events as predictable only after they happened. The hindsight bias poses a great challenge. At the same time it poses a great opportunity to learn how the markets work. For example, if we make a biased analysis of past market history, we tend to learn nothing about how the market works. However, if we develop the ability to perform unbiased analysis in hindsight, we can learn precisely how markets behave. The key here is being absolutely unbiased about what the market did in the past, which is not so easy. We must confront all possibilities of a market even when we know what the outcome is. That's the only way of extracting value of the hindsight bias. The outcome bias is when we make judgments about the quality of a decision when we already know the outcome of such decision. This is a blessing and a curse, so to speak. This bias has tremendous values. At the same time it can be misleading. This is similar to the hindsight bias, and it happens to all traders. When a trader opens a historical chart, he immediately starts to find specific points where his current strategy would have worked. The trader usually tends to ignore the places where the strategy would fail. The fact that traders can see in hindsight what happened with price creates this illusion that trading strategies would have worked a lot better than they actually do in real time. This dynamic of focusing on the parts where a strategy works and ignoring the parts where a strategy does not work is clearly misleading. As we saw in the video about the hindsight bias, we can extract some value of hindsight analysis if we analyze all possibilities of our strategies in the past, which is to not ignore the faults of the strategy. The restraint bias happens when people overestimate their ability to control impulsive behavior. This is one of the most important biases traders must deal with in the financial markets for reasons that should be clear to you at this point of the course. Impulses, by definition, are involuntary actions that come out of our primitive nature, which is still annoyingly present in inconvenient moments of modern life. One could argue that impulsive behavior runs in the opposite lane of what would be considered rational and intelligent behavior nowadays, meaning that smart outcomes usually spiral from well thought out and planned actions. However, this ability of making rational decisions is only possible in human beings after millions of years of evolution. In other words, the impulses and biases that enabled our intelligence to appear in the first place are the same impulses and biases that destroy this intelligence in modern-day paradigms. This is the paradox of our intelligence. The overconfidence effect is the illusion people have that their subjective interpretation of their own abilities is positively greater than the objective measurement of such abilities. You see this in traders all the time, usually in the ones who experience some level of success in the short term. Traders who experience success in the long term don't show overconfidence because, to be profitable in the long term, they need to develop ways of suppressing overconfident behavior, otherwise they will shoot themselves in the foot eventually. Overconfidence is such a misleading emotion because it feels great, but it slowly and silently destroys a trader's ethic. This is another cynical detail about our minds. We can feel well at the same time that we are acting in very counterproductive ways. Overconfidence is an exaggeration of confidence, of course, and it serves to demonstrate that our emotions should be carefully balanced inside a spectrum. Confidence is a good thing, but too much confidence will blind you and ironically make you underconfident over time. The key point is to always try to maintain yourself relatively confident without being whipsawed to either side of the spectrum. The Dunning-Kruger effect is the tendency people with low level of information have to overestimate their abilities and people with high levels of information have to underestimate their abilities. This bias is applied all over any financial market. There are tons of people with nearly zero education about how the market really works, and these same people feel like professional traders of the highest caliber. Meanwhile, we have a few people who understand a lot about how the market really works, and you will constantly see them providing caveats and hedges about their views of the market. The Dunning-Kruger effect happens for a very simple reason. People with more information about the market are aware of how much trading can go wrong if you don't know what you're doing. On the other hand, if you actually don't have a clue of what you're doing in the market, it's a lot easier to convince yourself that your trading skills are solid precisely for the fact that you don't have the necessary knowledge to test or measure them correctly. Beyond that, we already saw in many examples how traders can get results that look good on the outside but are doomed to fail over time. The Dunning-Kruger effect is yet another cynical and ironic face of the reality of our minds because it shows how knowledge can have a bad side attached to it. However, we must find ways of bypassing the disadvantages of having too much information about the market because there are only two possibilities here. We either know almost nothing about the market, which is obviously going to lead us nowhere, or we can know a lot about the market and try to calibrate how this information can prevent us from trading. The only reliable option is the second one without any doubt. The Peltzman effect is the other name of the risk compensation bias. The famous example of this is that drivers who use seatbelts tend to drive less safely and end up increasing their chances of getting involved in a car accident. In other words, the driver feels justified to drive less safely because he is mitigating some of the risk involved in driving by using a seatbelt. Ironically, this risk compensation software our brains possess tends to increase risk in overall terms. Just look at the driver example. He's simply increasing his risk of getting involved in an accident by driving less safely. There is a parallel between this car accident example and the use of stop-loss orders in the financial markets. For example, some traders feel that just by using a stop-loss order they are completely immune from any risks in the market. That's not true because you still need to know where and why to put stop-loss orders. You can't simply arbitrarily choose stop-loss levels and expect good results from it. The parallel is that traders will tend to justify a bad trade idea just with the fact that it has a stop-loss order attached to it. Notice that the Peltzman effect is quite subtle, and it can make you feel like you're reducing risk in the markets. In reality, the overall long-term risk is just being increased. Hyperbolic discounting is the tendency for people to choose a smaller and sooner reward over a larger and later reward. This is one of the major cornerstones in behavioral economics, and it has huge impacts on how traders act in the markets. Because of the risky nature of any financial market, traders will desperately try to avoid exposing themselves for too long. The immediate effect is to favor trade ideas that give short and quick rewards rather than trade ideas that keep you worried for too long about the outcome. This apparently makes perfect sense to us on an intuitive level, but it makes zero sense mathematically and statistically speaking. We already know that short and quick trades tend to have an unstable quality where the stop-loss order is either too close to the entry point or it has no logical ground for existing, or a mixture of both situations. Also, there is the important idea about risk-reward ratios, which is often distorted in these kinds of trades. Counterintuitively, the temporary success one can get from trades operating under these circumstances give the clear impression that the trader is slowly but surely building his equity with great consistency. This is exactly the opposite of what's happening. Unfortunately, our minds have this reverse way of reasoning when we deal with economic decisions, and that's one of the reasons why trading can be so mentally demanding. Apart from the challenges found in technical terms, this violently twisted perception we have about our decisions is a major deal breaker in how we see the trading activity as a whole. Hyperbolic discounting is a major bias, but it is easy to counteract it when you understand it well enough. It doesn't involve strong impulses that are hard to control in real time like a few other biases have. For example, in most cases it is easy to stop yourself from falling under the wrong scalping paradigm if you know how unworthy that road can be. The sunk cost fallacy refers to the error in judgment while analyzing the possibility of future costs based on past costs. The trading translation of this situation is when a trader ponders about the future outcome of his trades based on the previous ones. If the previous trades have been unsuccessful, the trader can see them as a cost that cannot be recuperated, and therefore, the state of mind in analyzing future outcomes would be affected. This is very common in the market, and it is similar to the gambler's fallacy in a way. The negative psychological effect that emerges when a trader is inside a losing streak should not exist in theory. However, we know things work a little differently in a real trading situation. There are subtle variables at play here, like the size of the losing streak, how much money was lost, and how the trader processes all of this information. It may be possible that viewing past trades that went wrong as costs is like giving a wrong connotation to these events. Once bad trades are settled, the trader must simply move on and forget about what he can't change. This is, of course, a lot easier in theory than it is in practice. I say this is a wrong connotation because this idea of cost can put you in a cascading mindset if you're not able to escape a losing streak. For example, as a losing streak grows in size, you will keep reminding yourself of how much money you already lost and how many trades in a row you lost. With each one of these trades, the psychological effect of losing will be greater and greater. The essential point is to discard the idea that lost trades are a cost. The ideal way of viewing such trades is that they are normal trades that ran their course, and losses not only can, but will be part of any trader's routine. The irrational escalation is the tendency people have for repeating a type of decision that has been producing bad outcomes instead of deviating from such type of decision to correct the course. This idea reflects the slippery slope quality of our minds in the intermediary terms of a losing streak. This cascading effect I referenced a few times over the course is precisely the irrational escalation effect. This is a cognitive bias because, mathematically speaking, there should not be any cascading effect at all. For example, let's say that a trader risks $1 per trade and we can measure how bad he feels when a trade is indeed lost with the same units, so when he loses $1, he will feel a negative effect equivalent to -1. Here is where the irrational escalation really occurs. If the trader loses another trade, his emotional state won't be equivalent to -2. It will be a little worse than that. Something along the lines of -2.5 perhaps. This effect keeps increasing with each sequential losing trade until a winning trade appears or a margin call happens. Weirdly, when we invert this situation, the irrational escalation doesn't occur so dramatically or doesn't happen at all. Notice there is a clear disadvantage here, meaning that it is a lot easier to feel bad emotions while in a losing streak than it is to feel good emotions in a winning streak. The irrational escalation can lead to a state of fight or flight where the trader fully triggers his primitive behaviors, which is something that always ends in disaster. The zero-risk bias is the tendency to prefer the complete elimination of risk even when the existence of alternatives that reduce risk is possible. In general terms, people tend to have a weird relationship with risk and traders need to deal with this problem in an amplified way. If traders were to always subject themselves to the zero-risk bias, it would be literally impossible to have a successful trading career because these traders would always prefer to avoid taking risks instead of exposing themselves even to situations where risks are significantly lowered. For example, the best a trader can really do is to apply a good methodology, but that doesn't mean risks will disappear. There is no magic about good methods. Their ultimate goal is to reduce risks while providing a framework in which individuals have the possibility to confront themselves with high-quality trading opportunities on a regular basis. Zero risk simply doesn't exist in the financial markets. The returns are always attached to some sort of risk. There is no doubt that risks vary greatly in terms of magnitude, but the absolute absence of risk in trading opportunities is an illusion even if you are remarkably aware of what you are doing in the markets. There is this idea that the more you know about the market, the more you are going to reduce your risks while trading it. That's true up to a point, but it comes a moment where it doesn't really matter how much more you learn about the market or how well you master your technical and psychological tools. Risks simply cannot be reduced to absolute zero. In behavioral economics, the disposition effect is when a person feels the impulse to sell something that has its value suddenly increased and the need to keep something that has decreased its value. In the first case, if a trader has a position in the market that has just crossed the limit between loss and profit to the profitable side, the immediate impulse is to sell such position for a feeling of immediate reward. The whole scalping paradigm is built, among other things, under the disposition effect. This problem gets a little more interesting when we add the second part of the disposition effect, which the propensity to keep a position in the market if it is on the loser side of the spectrum. Imagine the following situation. A trader opens one trade in the market without a stop-loss and profit-taking order. The trader is simply risking his money based on poor technical motives and perhaps no contextual understanding of the market whatsoever. In this scene, the emotional gauging related to this trade is completely up for grabs and it will probably be involuntarily attached to the objective notions of profit and loss appearing on the trading terminal. This is where the disposition effect clutches the situation and leads the trader through a frustratingly helpless destination, which is the state of being confused about trading, not to count the potentially awful capital losses that can occur. The problem here is that as soon as a trade goes into the positive side, the trader will try to close it acquiring a small profit, but the trader will hold the trade while it's negative with the hope it will come back to the positive side. This is hopeless of course because one trade going bad under this circumstance can wipe out a huge series of small and subsequent profits. The trading ethics in this case are completely the opposite of what they should be. Starting from the fact that not using stop and profit orders in the market is simply too irresponsible. Just imagine the devastating effects of aligning the disposition effect with hyperbolic discounting, the clustering illusion, the overconfidence effect, and all other biases that were presented here for that matter. As soon as we start to look at these things more closely, we can begin to understand how trading psychology is indeed very complicated. The pseudo-certainty effect, as the name clearly suggests, is the tendency to assume certainty when there cannot be. This bias goes hand in hand with the Dunning-Kruger effect because it deals with different levels of certainty based on what an individual knows and this individual's perception about the limits of his knowledge. Pseudo-certainty can possibly appear in the final moments before taking a decision to make a trade. The pseudo-certainty might function as sort of igniter to conclude the whole process of trading investigation, assuming there is one. We can never have absolute certainty about the outcome of a trade, but we can have a sense of enough certainty, which is inherently attached to some degree of risk. The problem with the pseudo-certainty effect is that traders who don't have good information about the market will usually display this bias in an exaggerated way. It's always recommended to be skeptical about the markets. Too much certainty can certainly be a problem. The backfire effect is the tendency for people to increase their level of trust in beliefs that have been just faced with contradictory evidence, which is the exact opposite of what should be done, hence the name of the bias. For example, if a trader believes that the stochastic oscillator is a great tool for trading, and another person provides evidence that contradicts that idea, the automatic reaction of the trader is to increase his trust in the stochastic oscillator. Again, instead of being skeptical about it, which is what rationality tells us to do, the trader will tend to take the easier route, or the path of least resistance, and let the backfire effect guide his behavior. This is a vicious circle because every time the backfire effect takes place, the deeply held and wired beliefs get stronger and stronger. Reverse psychology is when a person advocates a certain behavior with the opposite quality of what is desired in order to induce another person to act in the way it was desired in the first place. Reverse psychology is the cornerstone of market manipulation, and it occurs every day in pretty much all financial instruments. Market makers are incredibly skillful in employing reverse psychology in the markets because technical analysis presents a simple framework for that to happen, and most of the times, traders need years of study before they get to the point where they learn about this. Market makers can employ reverse psychology in the markets by manipulating price in specific areas to make the market look like it's about to do something, while in reality it's about to do the opposite. The less is better effect, as the name clearly suggests, is the tendency people have for preferring less options to choose instead of more options simply because it's easier. This feeling usually comes from the need to maintain things simple while dealing with complex matters. This is a paradox, of course, because it's impossible to treat a complex system with simplicity at the same time that one expects to understand it correctly. It's paramount to recognize that the need to keep things simple is a mere flaw of our minds, and that reality has no interest in adapting itself to our biases and flaws. It's the other way around. We must adapt our minds to deal with the complexity of reality if we want to understand it better. That's important because traders do this all the time. They get overwhelmed with contextual trading, so they give up on the idea to try something easier. At this point, you can probably imagine what's the result of that attempt. In this lecture, we are going to explore the fifth dimension of our professional strategy, which is called operational logic. This strategy dimension has to do with specific actions a trader can do to manage his trades in a more efficient way. For example, a good operational logic will guide you in the way you put stop losses and profit targets. It will also guide you on how to collapse the risk of a trade and the overall approach on how to manage what you can and cannot do with your orders. In the fractal flow strategy, the operational logic dimension will also tell you simple guidelines that should enable you to be aware of the subtle sleight of hands that the market plays on most traders when we deal with momentum divergence. You will notice that many times in the market, you will be able to find context for both sides. This might force you to choose between one of these sides, which is something that can have diminishing returns. However, before we jump into that, let's see what you can and cannot do with your trade orders. The basic premise of good operational logic is in the name. It's logic. If you want your trades to be managed in the best way possible, you must use sound logic to place your stop and target orders. The reason for that is quite simple. With a logically placed stop loss, you are much less likely to be stopped out if you compare it with an arbitrarily placed stop loss. The same happens with target orders. You have a much greater chance to hit a logically consistent target than a randomly placed target. This idea serves as a filter to open trades. For example, if you have a good context to open a trade, but you don't have a good place to put a logical stop-loss order, you simply don't take the trade. That sounds simple, but it can be hard to control the impulse to open a trade when you have good reasons to do it. The same thing works for the target orders, of course. The stop-loss order is not just meant to make you stop losing money. It's meant to give you some sort of extra layer of protection. For example, in a long trade, you should place your stop-loss a few pips below a solid market structure, which you should be able to recognize from reading the market using other tools of the strategy. Another aspect of operational logic is the ability to collapse the risk of a trade. This is something that can only be done when the trade meets certain criteria. For example, let's say you have a trade that is going well, but you're not sure if it has enough power to hit a minimum risk-reward ratio. If the trade is in enough profitable territory, you can move the stop-loss order to break-even level. The key here is making sure the trade has enough profit, so the natural noise of the market does not hit your stop by accident. One generally accepted rule of thumb is to only collapse the risk of a trade if the profit is equal or greater than the stop in terms of pips. As far as the fractal flow strategy goes, we need to pay attention to a very important detail regarding momentum divergence, which is what makes most people give up on the idea of divergence in the first place. In strong trends, momentum divergence will produce a series of bad signals against the trend. However, most traders gloss over the fact that there is usually a continuation or minor reversal divergence happening in the direction of the trend. These divergences are much subtler, of course, and some of them you can only see with the extra layer of fractal analysis you learned in this course. As a general guideline, you should always pay attention to both sides of the market simultaneously. Instead of trying to catch the ultimate reversal of the markets, try to catch the continuation movements that happen in a subtler way. By doing that, you have a much greater chance of producing profitable trades, and by paying attention to both sides of the market, you usually can trade both sides and be right in one of them. Assuming you're using good risk-reward, if you're correct 50% of the time in your analysis, you will become a consistently profitable trader. By training yourself to be less biased about the direction of the market, it's much easier to develop a better edge against retail traders. Most of the participants of the market are always worried about catching the ultimate reversal. If you want to step away from the herd, you must look at subtler details. These tips and guidelines seem to be almost too simplistic, but they make a huge difference when you start to compound them over time. In the next lecture, we are going to explore the sixth and final dimension of a professional strategy, which is the trade plan. The trade plan is an incredibly important part of trading for a few different reasons. The most obvious of them is the fact that a trade plan enables you to act impulsively and deliberately at the same time. In other words, a trade plan gives you a quick answer to complicated problems about trading. A trade plan has two main sections. The first is composed of the global variables of your trading. In other words, the global variables are the variables that apply to all trades that you are going to be doing. Things like the arbitrary risk percentage, minimum and maximum risk-reward ranges, maximum stop-loss size in terms of pips, allowed timeframes and maximum number of losing trades. The second section of the trade plan is the plan you will need to develop to each individual trade. This is the important contextual elements that we have been talking about so much over this course. There are several ways of keeping track of your individual trade plan. You can take screenshots of your trades before and after they happen, you can write the context of each trade, or you can record a video of the trades you make. This requires some effort in the beginning, but it has extreme value. Going back and seeing what you did correctly and incorrectly in each trade is a tremendously powerful learning tool, far greater than anything else. You will notice that you seem to be one person when trading in real time, and a different person when you analyze what you did in real time. If you followed this course correctly, you already know why that happens. It's because when we deal with economic decisions in real time, a whole array of cognitive biases begin to steer our thought process. On the other hand, when we analyze our trades without being subjected to the unfortunately distorted bounded rationality that trading wakes up in all of us, it's much easier to identify qualities and flaws in our actions. Ironically, this is a way to take advantage of our bias blind spot in a way. As far as the trade plan design goes, it doesn't get much more complicated than this. The difficult part is actually making sure that you will follow this plan religiously. This is the basic framework of a professional trade plan. Keep in mind that every trader has a unique trade plan, that's why we are only providing a framework for you to build your own. In the next lectures, we are going to see the fractal flow strategy come to life in several examples by applying everything we have learned so far in the course. This lecture concludes the theoretical portion of the course.